trade fears reared their ugly head again today and the dollar rallied. So I'm going to break down how these other asset classes responded to today's dollar rally compared to normal and what that means. Also, retail is having an explosion. So with today's trade idea, we're going to trade the strength in the retail sector in a more indirect way. So let's go ahead and get started. Today is Thursday, August the 23rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the logo right here, the Market Scholars logo, in the bottom right corner of your video. Then click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You liked the video tonight, you got something out of it, and you want us to do the video again tomorrow. Really easy way, one-click way to give us feedback. You can do that right now while we're speaking. Comment on anything that stands out. We love to hear from you on what you think about what you watch in these videos day in and day out. Join our Market Outlook, our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day and throughout the week, and join our Market Outlook community on Facebook. All right, let's take a look at the S&P 500 here with the market forecast indicator like we always do. You see that five-point pullback today, roughly 5 points, kept the intermediate line in the upper reversal zone, so we're still got a strong bullish posture. It is pulling back a little bit, but again, it doesn't matter if it's going up or down or sideways. If it's above 80, it's strongly bullish. If it's above 50, we're still on the run, right? We're still on this intermediate run. That's when it gets these dark pink shadings below 50. That on the green line, that's when you get the bearish posture. So we're still maintaining a bullish posture that we have now. Again, going on 2 months, and 2 to 3 months, or 1 to 3 months is the expectation, and we were looking for 2 to 3 months because of that early overbought cluster that we got that I mentioned before. So, we got about another week left in August, which is a very important thing I'll bring up here later in the video. We got about another week left in the month of August, and we're currently on what is the second intermediate run. Here's the first one, here's the second one. Of this current long-term move that we've got going on with market sentiment in orange crossing above 50. So the low point was set here with market sentiment below 50, and then of course we're coming off that low point so far, like I said, in the second phase of this intermediate rally. The first intermediate run wasn't that long, and we talked about during this particular long-term run compared to the last one that we would have shorter runs. See, the last one we had abnormally long intermediate runs. The first one that occurred in late 2016 after the election, spanning into beginning of 2017, lasted 4 months, so beyond the expectation. And then now the last one, you see where my cursor is, that one lasted 5 months. So again, way beyond the expectation. So we're not going to get those kind of moves, I don't think. Of course, anything can happen. I don't necessarily think we'll get those kind of moves here, but again, the end of the year, that kind of 4-month run tends to be a pretty bullish run just from a seasonal standpoint anyway. If I were to take a look here, this is the seasonal chart for the S&P 500, and you can see once we get through September and September and early October tend to be relatively weak from a seasonal standpoint, then there's a good run. So you include September, October, November, December. From August, you can see it's a pretty good move into the end of the year that we typically get. Of course, we usually are in the middle of a bearish move currently, and that hasn't been the case since the middle of July. We've been pushing with higher highs and higher lows, and so we've since the end of June, we've really come up off of sharp off these lows when we started this intermediate run. So seasonality isn't always picture perfect, but over the last 20 years, the end of the year tends to be a pretty good time for equities. Go back to the market forecast here. You can see we got the oversold momentum line again. So again, that combination of an oversold momentum line with a strong bullish posture is a good bullish signal, a buy the dip signal. In this case, the near-term line did not stay above 50 like it did yesterday. So we only had 6 days of the near-term line above 50, but now we got a bullish intermediate confirmation signal with the potential for a bullish near-term low. See, the last near-term low point was right here, and you go up to the chart, and it was that a week ago yesterday when we hit that low. That was our last near-term low, so this would obviously be a much higher near-term low point if we bounce off of this. So this is a good combination for equities heading into the end of the week to have an oversold momentum line, to have this intermediate confirmation signal with the potential for a bullish near-term low point. And then, of course, you got the strong bullish or strengthening bullish long-term market sentiment that, you know, again, 6 to 9 months is what we look for. We crossed above 50 over here in early June, so we are just over 2 months into that run. So, you know, we still got the potential for multiple intermediate rallies to fill in that typically bullish time of the year at the end of the year. You can see the Dow Jones Industrial Average now is also giving us, after that extreme low yesterday, that's a little bit of a red flag. It is now also giving us an bullish intermediate confirmation signal, so oversold momentum line with the intermediate posture being strongly bullish, and a potential for a bullish near-term low. Now the near-term line did dip its toe a little bit below 20, so that's a little bit of a concern. It's been a little volatile, and it's only spent a few days above 50, coming down from a higher near-term high point, which is right here to here. And obviously this would be even with the dip below 20, even with only a few days above 50, because we had such a strong bounce in the Dow, it would be a much higher near-term low point if we bounced off of this. So little red flags with that extreme low on the momentum line and the dip below 20 on the near-term line, but not, I would say more of a yellow flag, more so than a red flag. Caution, but not, okay, we're changing the trend, right? Because we still got the trend intact, and we're not threatening the prior near-term lows yet anytime soon. You look at the NASDAQ Composite, its near-term line did pull back a little bit with only a little peak above 80, but it's not below 50, so you know it's again another yellow flag, but not trend-changing expectations. Not quite able to get above all-time highs. You can see how we're kind of getting these higher lows, so it's like it's trying to load up and push through here. Might need some volume to get through there. And then you can also see the Russell 2000, which did bust through to new all-time highs, pulling back a little bit today, but not, I mean, after breakouts to new all-time highs, return moves, very short-term return moves, are very expected. I mean, so that's the kind of move we're getting right now. And it also is giving us a bullish intermediate confirmation signal. This time not with the potential for a bullish near-term low point, but with a strongly bullish short-term sentiment. So this isn't necessarily a buy the dip rally or signal. It's more of we got this near-term run that we're on. We had a little pause today, and the signal would tell us it is just that, just a little pause. It's not a dip because it's one day and we're basically back to Tuesday's close, but it is a pause, and we expect that pause. We expect us to unpause as early as tomorrow with what these signals, these intermediate confirmation signals, are telling us. Alright, before we look at other charts, a reminder that you can watch our Market Outlook video on our Market Scholars blog. Just go to marketscholars.com, click on blog at the top of the screen. You'll see our typically tonight's Market Outlook video at the top. Remember, if you click this link right here, it will take you to our Market Scholars forums where you can reply. You click on reply right there, or just scroll down to the bottom of the page, and you can reply to tonight's Market Outlook thread with any questions or comments that you have. Again, you have to subscribe to participate in that. You can do that for free up here by joining Market Scholars, clicking on that image. Remember, if you want us to keep doing these videos, we ask for 3 clicks that you can do right now while you're watching. Number 1 is to click on the heart and like tonight's Market Outlook tweet. Number 2 is to click on that Facebook image. That will take you to your Facebook account. Click on like right there. And then 3, to like it here on the blog. And remember, the more you share it, the more you tell these platforms this is good content that other people should check out too, whether they follow you or not. And we've gotten 52 as our new record, so we're trying to hit 100. 100 is the goal. So the more you can retweet or share on Facebook or share on LinkedIn, the more we can get closer to our goal. All right, back to our charts here, and you can see on a long-term basis, as weak as we've been the last few days, we haven't been that weak, but as weak as it's been, as not bullish as it's been, we are still very bullish on a long-term basis. So still rising, riding above a long-term moving average. So it's, again, I mean, there's lots of reasons that people would want the markets to go down. Or think that they should go down, but it's hard to be too bearish when that's your long-term chart. I mean, it's not like we're exploding off of the 50-day moving average at extremes, right? We're just grinding our way higher, and it's not even now. Now it is relatively high. The MACD, the gap between the 50 and 200 is relatively high, but remember, it typically doesn't go from high levels down to 0 without grinding away lower first, and so. And as it grinds lower, you'll see it continues price continues to grind its way higher. If you take a look at the 3 green arrows, we'll look at the 3 green arrow chart here. You'll see that again we still have the 3 green arrows, so we're still shaded green on the market forecast. We're shaded green on that long-term chart. We're shaded green here because we got 3 green arrows. You look at the 2-line versions of this chart, and you can see we're still above the moving average, even though the MACD did pull down a little bit. We are kind of going with that short-term buy the dip signal that we're getting on the S&P. We are at the 8-day moving average again. So we either bounce off of this and continue to make another near-term run, or we continue to pull back. And of course, the expectation is for the bounce off of that. And you can see as well on these other charts, on the intraday chart, and this is what I tweeted out earlier today, when we got to these lows, see you can see why we're kind of stuck at these lows and not precipitously falling here, because we've got some support at yesterday's low point. We got support at last week's high point, which was on Friday. We also had some support from over here, so these old 4-week highs. So we've broken up to new 4-week highs earlier this week, and we've made a return move back to the old 4-week highs. So we bounce off of this and continue to push higher, or we don't. And again, the expectation according to the trends is that we would bounce off of this. Support holds until it doesn't, right? You expect it to hold until it doesn't. Again, during this little period of weakness, as I mentioned before, volumes have been really light, 49 million this time. The trading range at 1.5 points. You put that in the context here according to their average. 1.5 points is below the 2-point average, way down here, and that's actually a little bit higher than what it was last couple of days, but still pretty low. It was yesterday it was 1.19, and the day before that at 0.9. On Monday 0.91. So it's been a quiet week from a range perspective. Volume at 40 some odd million. Again, below the average and way down in the 52-week range. And you can also see too that the relative ATR compared to that 1% level is still low. And again, for to get above 1%, the absolute ATR down here would have to get up to 2.86. And you can see instead of rising, which is what it can do, as we kind of blow off top here. We're actually still falling, which is bullish. Now let's take a look at the volatility here, and you can see we are up a little bit today off of the lows that we had here earlier this morning. Still trading around 12.5, so still pretty sideways. You can see that this was a lower low, and we're in the process now of forming a high on the stochastics. And the last high we had was right here, so we'll see. We're kind of in a tight range in volatility as well. and that tight range happens to be inside the bullish territory, the bullish zone. Not extremely low. We were extremely low early this morning, but it's right in the sweet spot or close to the sweet spot of bullish territory for volatility. So nothing yet is really standing out to say that we should expect more bearishness, at least on the charts that we use in these in this routine. So what do you think? Now I want to hear from you. I've given you my posture. We are bullish and we're grinding, and we expect that to continue with a short-term bounce here heading into tomorrow and beginning of next week. What do you think? Do you agree with that or disagree with that? There's a poll popping out in the top right corner of your screen. Click on that link and then answer that poll. One answer, one or the other. And if you click on disagree, we'd love to hear your thoughts. Scroll down to the bottom of the page here on YouTube or on MarketScholars.com and comment, reply to this thread or the video and comment on what you're seeing that would suggest that we should be a lot more bearish than this. So let me know your thoughts, or some of you may think that we should be more bullish. You can let us know there too, and add in our Market Scholars forums to the conversation about the market in our Market Scholars community. All right, now let's transition into what's driving the price action today. And of course, tariffs were the news of the day again, with new tariffs, with trade talks being going on between the U.S. and China, but new tariffs being assessed from both sides, even with these trade talks occurring. Because of that, of course, we know the response to any kind of tariff-related actions, and that is strong dollar and everything else down, including international stocks, to a bigger degree, and that's kind of what we saw. They had been rebounding. See, the dollar had been pulling back down here in the bottom left corner, and the dollar and everything else had been rebounding, but the dollar bounced. Gold dropped. Agricultural commodities again down to 3-month lows. Crude oil, a big bounce yesterday, but a small decline, as you can see, pretty flat on the day. Bonds were up. In fact, look at high yield bonds are up at 3-month highs. Foreign bonds are relatively flat. Long-term bonds have been making a sneaky move here. If you were to put this back to a 3-month high here, you'll see that they are also close to a 3-month high, long-term bonds. So they've been kind of sneakily bullish, kind of creeping up on everybody with a, if you take a look at a long-term chart of the 10-year yield, and you can see breaking down below, this week, breaking down below what could be a neckline of this head and shoulders pattern that we're seeing developing with falling momentum towards zero, and you can see closing below multiple weeks. So now granted, we still got a day left, so we'll see what yields do tomorrow. And you also have this divergence with lower highs on the MACD, with obviously much higher highs setting up the head and the first shoulder of that pattern. That's the 10-year note. If you look at the 30-year bond, you can see it's breaking back down below its 200-day moving average, which is that blue line, 50-day or 40-week exponential moving average. Its MACD is also dropping, close to getting that death cross again. So just like that, as bullish as people were on yields, to a historic extent, the positioning, the futures positioning for yields has been very short bonds, like to an extreme, and we're seeing a little bit of a kind of a short covering rally right now on that. So bonds are looking relatively bullish here. Let's get back to the intermarket analysis chart. Bonds have been looking, like I said, sneakily bullish. You'll start to see some of these kind of sideways out. Municipal bonds, mortgage-backed securities, they tend to do better when bonds are when bonds as a whole are dropping. Mortgage-backed securities are at close to 3-month highs themselves. And you can see some of these the different types of equities, kind of specialty types of equities. You've got real estate, REITs pulling back. You have dividend stocks pulling back. You have preferred stocks pulling back. You have MLPs pulling back. So with rising bonds, these types of equities don't do as well in that type of environment. And again, we're seeing a little bit of a pullback there. If bonds continue to rise, which according to that price pattern you would expect, then you'd probably expect to start to see some weakness in some of these areas here again. Of course, it was a king dollar kind of a day. If you look at the currencies here, and we'll take a look at the currency charts. It's actually over here. Currencies on 4P. You can see the dollar was up. Let's see, I changed this to a 90 days. So this is back, actually since we started our portfolio management class. You can see I tweeted out. We had our portfolio management class today, and we're managing a class portfolio, tilting based on macro conditions in different areas, and today, so this is the returns on these currencies since we started. The dollar's been very bullish since we started that class, and you can see which has been the bearish. Let me go back and just sort this, change that back to a regular. Oops, nope. A regular 3-month return here. So you can see the yuan's been the weakest performer. So this is kind of a U.S. versus Chinese currency. Even though yuan wasn't down today, interestingly enough, the biggest loser today was, aside from the Australian dollar, a little bit of a link to commodity prices. You have the British pound, the Canadian dollar, and the yen all lagging. So if you look at how the dollar's performing, remember these are the euro bouncing back down a little bit. The pound, look at the Australian dollar back down to 3-month lows again. New Zealand dollar kind of following with the Aussie. The dollar bouncing up against the franc off of 3-month lows, bouncing up against the Canadian dollar and the yen quite a bit there, as well as against the Singapore dollar continuing a trend. So you can kind of see these European currencies, which have been so weak, they held up okay today during this dollar rally. So we'll see who has the biggest loss. I mean, the Canadian dollar and the Japanese yen were able to hold their value much better during the previous dollar rally, and see if that ends up being the case, as they're now losing some of their value while these European currencies are holding their value much better. The franc, the euro, and the pound down, having a relatively down day today out of all of those. And now we take a look at the foreign markets and see which ones did better today here. So we'll come over to foreign markets. We've got a couple of these I'm going to take off. Oops, not E. I don't want to get rid of Germany. I want to get rid of that one. So again, it was a 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, so it was a, again, U.S. outpacing again. That's what you expect during these trade wars. And you can see, Russia on the downside, Russia back down to 3-month lows again with another oversold cluster. China bouncing back down. Brazil really close to 3-month lows, trying to figure out a double bottom potential pattern here. Really big declines, 18% over the last 3 months. In fact, double-digit declines in all of these down here. Italy, the worst performer in Europe, and Korea kind of matching what's going on with China and Japan to a smaller extent. But those Europeans holding up better. France holding up better. Germany holding up better. UK pulling back, but not as bad. Not as bad as some of these emerging markets. You can see even India, which had been doing better previously. So it's almost a little bit of okay, the dollar was up today, but maybe it wasn't up necessarily for the same reasons that it's been up in the past. Maybe today it's only up because of kind of an oversold bounce, because it had been down for the past week quite a bit, and so it bounced, and it bounced the most against the asset currencies and markets that had been doing the best previously. So India, Canada, the Canadian dollar, Japanese yen, all of those kind of pulling back. So maybe this today wasn't necessarily about trade, and it was more just a technical bounce and a relief against areas where it was down, where the dollar happened to be down the most over the more extended period of time. It wasn't down the most against these areas in the past week, but over the past few months, India had been one of the better performers. Canada had been one of the better performers. The Canadian dollar as a currency had been one of the better performers over the past few months. Now when you look at the sector rotation today, look at technology is the only sector that was up. So that had been weak, bouncing up a little bit today, pulling back off of its highs. A lot of that kind of coinciding with some strength in Chinese tech stocks, which have been really beaten up. So the tech sector holding up very well. As I mentioned yesterday, that NVIDIA, which was a play for us, taking advantage of relative weakness in the technology sector, because again, this is sorted by Brandon's sector selector rankings. Technology had been weakening, but NVIDIA has just kind of blown through. It's all up to new highs, and you can see a lot of that strength. I think AMD here in the after hours has done really well and blowing up to new highs, or blowing up today after earnings. So on the other hand, again, strong dollar continue to put pressure on these poor areas down here, energy and materials. They continue to struggle the most. Everything else is on strong trends, and those two are below a falling moving average on pretty much both of them. This one will turn red probably tomorrow. But those interest rate sensitive areas, you can see they're pulling back with bonds rallying here. These areas, these stocks, with yields falling, these are pulling back, interestingly enough. Whereas healthcare is maintaining its strength. Discretionary, you can see healthcare, one of the better performers. Of course, technology, discretionary. These two, technology and discretionary, when the markets are bullish and the dollar is strong, those are your two sectors that you expect to continue to outpace. Financial sector, like these two dollar-sensitive area sectors, the financial sector struggling with the yield. I mean, it's close to 3-month highs, but it's really been sideways. If I were to zoom out to the full year, not even close to all-time highs, and with yields kind of bottoming out, or excuse me, with yields topping out and rolling over, that will not help this financial sector in the least. One pocket of strength that we've been seeing, obviously, is in that retail sector, and one indirect way to play that, of course, is with these payment processor companies, Visa being one of them. Visa, again, close to its all-time highs. Remember how the market peaked in January, and Visa's well above that peak. So it's been a strong bullish trend, well positioned to take advantage of strength in the consumer. It's got a bullish posture here on the market forecast. Short-term sentiment bounced up with a close above multiple weeks highs here. So a good bullish bounce. Still got to get up above this kind of false break. So you had that false breakout move that came back down. So we still got to kind of get above those highs after earnings. But still, a good trend, a good move. You look at the 3 green arrows for Visa. You can see back to 3 green arrows at their brief period of having 1 red arrow. So buyers are in control. Low volume move. It doesn't need a lot of volume when it's got the trend helping it along. If you take a look at some of these others like the DMI for Visa, you can see that getting both lines are down below 20. So the trend is extremely low. At some point in time, one of these is going to break out above 25 and renew a trend. You can see what happens. It doesn't stay below 20 for too long. This has been an unusually quiet period for the stock, and the expectation is to get a little bit of a bounce out of this. You look at the Bollinger Bands here to see a similar story. You can see Bollinger Band. We've had. I mean, this was a lot of volume in this area compared to where we've been in this past year. Most of the volume of the past year was down here. Of course, we broke out above that in this area, made a return move back down, set that low point there at 130, and then made a new move higher, consolidating here at 140. Now the expectation is to push and make a new move higher again with the bandwidth low and price staying in the upper half. I mean, as tight as we've been staying in the upper half of the Bollinger Bands here with the percent B being above 50. So continuing to trend, there's an opportunity to ride that trend. So, whether you want to buy the stock with a support stop order down below these lows, buy an ATR, whether you want to buy an option, you can go out, in this case 85 days, buy that at the money option, 140 here, setting a stop order. 50% of that going for a 2-to-1 profit loss ratio at a minimum. Of course, looking at another alternative is just like what we normally do here is to sell puts. You could sell the 140 by the 138. You can see what that looks like here. Throw that onto the break even onto the chart, so you can see as long as we hold above that, you make your money, and you've got support in this area. So multiple ways, but considering the opportunity for a breakout to occur, you might be able to be a little bit more aggressive here and ride that strength in the consumer to continued strength with Visa, especially heading into the end of the year. You can see last year we just into the end of the year it just continued to grind. We had a nice good grinding move higher. We can expect that. Now this option, if you buy the November, would expire. Whether you buy the stock, you can hold as long as you want and ride the trend as long as it takes. If you buy that option, it will expire November, and there is no December. If you go out, well, there is a December. You can go out to December here. It's kind of in the long end of the range. It's going to be a little bit more expensive, so another $1 to get that out the money, the 140. But that would let you hold it through the end of the year, at least to the third week. Of course, that's all extrinsic. Well, most is $5 of extrinsic value, so the stock would have to rally at least $5.50 for you to offset the loss in extrinsic value if you held it all the way to December, and then some to make money, right? And you're paying $7.70, so you see how much you would have to make just to cover the cost, to cover the risk that you're getting into this trade. And of course, if Visa is a stock that you want to trend trade throughout the end of the year as it continues to trend higher, you can pay $142 for it, or you can pay $7 or $8 for it with the option. So you can see the benefit of that leverage, and you can position size and manage risk. As always, now I want to hear from you. What do you think about that trade? What do you think about the market posture? Is there anything that you had a comment on that we discussed today, or a question? Is there any questions you have about something I didn't discuss? Click that link popping out in the top right corner that has already popped out there. Or you can just click that little I and it will open up all the links. But let's go to the forums and let's continue the conversation there. Remember, we have a very knowledgeable Market Scholars community. They've been watching these videos for some of them for years. So take advantage and ask questions and keep the conversation going with others of you, 1,000 of you that are watching these videos day in and day out, or more. So thanks again. Have a great evening, everybody. Remember to subscribe to our YouTube channel, like the video, comment, follow me on Twitter for more content like this, and join our community on Facebook as well as on MarketScholars.com. Have a great evening, everyone. We'll see you all next time.